Welcome back to the Neuro Finance Masterclass. Today on Day 103, we break the biggest illusion of fundamental analysis. I'm Ibrahim, and alongside my co-host, we're diving deep into the relational matrix in today's explainer, specifically mastering sector multiples. So get ready, because what we're covering today, it's going to fundamentally change exactly how you look at a balance sheet.
All right, let's run through the syllabus for today. We've got a tight 5-part agenda. 1. The context trap. 2. Asset heavy versus asset light. 3. Defining peer groups. 4. Sector cycles. And finally, number 5, the relative audit. Let's get right into it.
Starting off with Section 1, the context trap, or the illusion of the universal baseline. So after mapping out global liquidity matrices over the last few days, days 100 through 102, we are officially back to the micro level. We're back to the balance sheet. And the quote, "A P of 35 is always expensive," is exactly the fatal context trap that amateur investors fall right into. You see, after learning about basic metrics back on days 88 and 89, people just take a single, rigid rule and apply it to the entire market. That is a complete myth. Listen to me on this one. Comparing a tech company's PE directly to a steel manufacturer's PE is, frankly, financial suicide. You just cannot use a universal yardstick like that. A true architect never evaluates a corporate multiple in isolation. It literally must be analyzed within its specific sector matrix. If you do anything else, you're basically just trading blind.
Which brings us to Section 2, asset heavy versus asset light, essentially comparing apples to oranges.
Think about it. Asset-heavy sectors carry immense physical gravity. We're talking massive capital expenditures, colossal factories, endless raw materials, and incredibly complex logistics. Because of all this physical friction, their growth is by nature slow and very linear. But then, on the flip side, consider asset-light sectors like software. They scale globally with almost zero physical footprint. They command massive profit margins, and, just like we discussed back on day 70, their compounding potential isn't linear at all. It is explosive. It's exponential. And the market prices that difference very aggressively. So for asset-heavy industries, your energy, your steel, automotive, the market values them at much lower multiples. You should really expect a PE between 5 and 12. But for asset-light software, tech, and AI, the market actually rewards that exponential scaling potential with a PE of 30, 80, or honestly even higher. If you put a software giant next to a steel mill, the raw math is always going to falsely make the software look expensive and the steel mill look cheap. But they aren't even playing the same sport.
All right, moving to Section 3, defining the peer group and calibrating the baseline.
So, if we absolutely cannot compare across the broad market, we need a contextual framework. Enter the peer group, or akran grupo. These are the exact global competitors of your target company. We aren't looking at the whole market anymore. We're looking at specific gladiators fighting in the exact same arena. From there, we find the industry average, or sector ortalamasa, which is just the calculated mean of the financial metrics for that highly specific group. Let's break this down. If the industry average PE is 10 for the automotive sector, and your target company is sitting there at a PE of 6, all while maintaining a superior DuPont ROE like we mapped out on day 99, well, that company is genuinely undervalued. It's a highly efficient machine trading at a real discount. But if your target company is a PE of 18 in that exact same industry, it's objectively overvalued. The math plainly says they are too expensive relative to their specific environment, and it doesn't matter how flashy their marketing is. Next up, Section 4, sector cycles and expansion, surfing macro seasons. You have to remember, sector multiples are not static. They are deeply dynamic and fluctuate directly with the macro seasons we established back on day 97. During economic expansions, massive amounts of capital flow into growth sectors like tech, which aggressively expands their multiples. But when the cycle turns cold, entering the economic winters we covered on day 72, terrified capital rotates right out of growth and straight into defensive sectors like utilities and consumer staples. The tech bubble compresses and defensive multiples rise. This right here is called multiple expansion. It's when the market willingly, happily even, pays a premium for future earnings during economic expansions, driving PE ratios up across the board. A true financial architect surfs these cycles by knowing exactly what multiple is reasonable for the current macro season. You align with the season, you don't try to fight it. And finally, Section 5, the relative audit execution. Let's put this into practice. Okay, here is your actionable step-by-step masterclass assignment for today's explainer. Step 1, pick just one single stock from your portfolio.
Step 2, open up your financial screener and look up its exact industry sector. Step 3, find the average PE and PB ratios for that specific sector. And Step 4, compare your chosen company directly against that industry average, as well as its closest direct competitor. Seriously, we have got to stop trading numbers in a vacuum.
So to dismantle the absolute biggest illusion in fundamental analysis, lock in these 3 pillars. Filter by sector. Never compare software to steel. Calibrate the baseline. Always find the true industry average. And rule the cycle. Know for sure whether you're sitting in a booming expansion or a defensive winter.
Which leaves us with one incredibly pressing question to audit your portfolio today. Is your asset truly a bargain compared to its exact peers? Or is it just the shiny cover of an overvalued box? Execute the relative audit, and we'll see you back here for day 104.